ultimately dismantle any of it if we don't stick to a intensely radical politic.
You're not broke if you're taxing rich people.
We break production for profit and we replace it by production for need.
This event is brought to you by Haymarket Books. Now more than ever, it is critical to support independent publishers, independent bookstores, and independent voices. There are two ways you can do this today. First, by buying books from Haymarket at haymarketbooks.org. And secondly, by joining the Haymarket Book Club. The following event will be recorded and shared afterwards on the Haymarket Books YouTube channel. Please subscribe to the channel, like this video now, and share it with as many people as possible. If you like this event, be sure to catch these upcoming events in Haymarket's live stream series. You can register for these upcoming events on the Haymarket Books Eventbrite page. If you miss an event, you can listen to the recording afterward by subscribing to our podcast, Haymarket Live, wherever you get your podcasts. Before we begin, a few housekeeping items. We are moderating the chat, but we cannot guarantee that everyone will observe our community guidelines. People who violate these guidelines will have their comments deleted as quickly as we are able. This event will have live closed captions. Instructions for accessing the captions will be posted in the chat. We should have time for Q&A, so please post your questions in the YouTube chat window, and we'll get to those later in the program. Thanks for joining us today. Our event will begin shortly.
Hi, everyone. Welcome to Banks on the Brink, Financial Crisis, State Bailouts, and the Global Slump. My name is Shireen, and I'll be moderating the event today. Today's discussion is organized by Spectre Journal and Haymarket Books. Spectre Journal is a new Marxist journal that aims to reinvigorate debate on the revolutionary left, recentering questions of oppression. Thank you to Haymarket Books for co-sponsoring the event, and thank you also to Amanda Lundberg for live captioning. The event is free, but we ask that those who are able to make a solidarity donation to our publishing and programming work and subscribe and donate to Spectre Journal to allow our radical journal to continue. All of us have likely been hit by inflation over the past year. We've seen the cost of eggs, in particular, balloon, and now many of us are watching as Signature Bank and Silicon Valley Bank collapsed and wondering what's coming next. Today's event will aim to explain these circumstances from a left-wing, a Marxist perspective, and explain what this means about the economy and the future trajectory, the trajectory of capitalism, and so on. So our speakers are Michael Roberts and David McNally. Michael Roberts is the author of The Long Depression and Capitalism in the 21st Century. David McNally is the author of Global Slump and Blood and Money. Unfortunately, Hadass Thier was not able to make it today, but hopefully this is the start of a longer conversation that she and others will be part of. So we're going to start off with talks from each speaker for about 12 minutes and then open it up for conversation between the two speakers and then followed by audience questions. So feel free to take it away, Michael.
Thank you, Shireen, and thank you, Spectre and Haymarket, for inviting me to speak on this issue, which has exploded in the last few weeks, starting in the US and spreading into Europe, namely yet another banking and financial crisis. We remember the global financial crash of 2008-9, and regularly there are problems with banks, but now we seem to have a major development that we haven't had since then, exploding in the last 3 weeks. What's the nature of this particular banking crash? Well, in a way, it's a classic run on the banks. The people who have deposited their monies in these banks, in particular 3 of them, have rushed to remove their deposits and put them elsewhere because they fear that the bank will not be able to meet their cash demands when they need it. We started off with the Silicon Valley Bank, and that's significant because it was in California and concentrated getting clients from tech startups in particular and from venture capitalists in the tech and pharma industries based in California. Companies and rich individuals would deposit their money at the Silicon Valley Bank. SVB, as a result of that, had a large number of deposits concentrated in this sector and at very high levels of deposit level, above the official threshold for getting your money back from the government, as it were, or from the banks in general, of $250,000. Once you're over that, you're uninsured, as it were. And so that money is open to be lost completely. And suddenly there appeared to be a run on the SVB, followed up by a run on another bank, Signature, which concentrated on cryptocurrency clients. And then later on, First Republic, a bank also that had large cash depositors in California, although it's in a way New York based. These 3 banks suddenly had a real rush, in particular SVB, which suddenly lost tens of billions of dollars within hours. Remember, now we're on the internet as we speak. We no longer have to go down to the road and bang on the door for our money. We can just press a button and it comes back to another account that we have organized for. So that's what started to happen very quickly with SVB. Why? Well, it appears to be the case that SVB found that it could not meet the level of cash withdrawal demand. Why was that? Well, a lot of tech companies are finding it much more difficult to make ends meet in the recent period, particularly startups. They found that the money they're getting from venture capitalists was being cash burned very quickly, and they weren't getting any more. Why? Because venture capitalists were saying, well, the tech industry doesn't look so great. Profits aren't going up as much as they were before, and people are not making money. So these tech firms were starting to burn their cash fast, and it became clear that the board of SVB couldn't manage to pay all those withdrawals as they picked up, particularly when it became clear that everybody else was withdrawing. Why was that? Because what SVB had done, they'd invested the cash deposits that had been put into the bank into government bonds. Now, what could be safer than government bonds? What could be safer than Uncle Sam? It's not going to go default. But what they did was they invested in 3-5-year bonds, which meant that they couldn't get their money back unless they sold them on the secondary bond market. And because interest rates have been rising hugely since the Fed started hiking rates just about a year ago to much larger levels of interest rate that existed when SVB bought its bonds, the value of those bonds have dropped away in the secondary market. So it's like buying a second-hand car. It gone downhill and the value of the car had deteriorated, and yet they were forced to sell it. They couldn't wait until they got their money back in 3 or 5 years. So when it became obvious to depositors that SVB was unable to meet its cash demands, then there was a massive rush on getting their money out of it. And the bank very quickly not only found it doesn't have enough money, it was basically insolvent, and it had to be closed down within days. That situation spread to, say, the other 2 banks, and fear then raised that it was going to spread to a whole range of smaller regional banks in the US, and it seems even in larger banks in Europe, there was a beginning of fear and a run on the banks. It's now estimated that something like $600 billion worth of bonds held by these banks are unrealized losses. In other words, if they had to sell them today, they would lose $600 billion. That's about 2% of US GDP. So that gives you an indication of the damage that could have been caused if these banks fell apart and were forced to sell their bonds. So naturally, what has happened is that the Federal Reserve and the monetary authorities have stepped in, and they have offered huge amounts of liquidity, borrowing facilities in order to enable not only SVB, who has gone to the wall, but other banks to keep going like First Republic. It's estimated in just 3 weeks, the Fed has lent out $600 billion through various different facilities to mainly regional banks, mainly in California, but not just there. And on that basis, they've tried to prop up the banks and convince people, depositors and others, that there is not going to be a banking crash. And Jay Powell and the US Treasury Secretary Janet Yellen is telling us that the banking industry is resilient and there's no problem. We've got plenty of cash. We'll be able to handle this. Well, that may or may not be the case. All I would add in the time I've got available is that this crisis, in my opinion, is not over, because these banks may have got a lot of government bonds which aren't worth what they were before, but they've also lent huge amounts of money into the commercial and real estate sector, commercial real estate, into offices, malls, other buildings and structures, not residential, but into this area has been a big lending area, particularly for small and regional banks in the US, and also in Europe in the case of Credit Suisse, which has just been taken over, and also Deutsche. So there's huge liabilities or risks for these banks because the housing market is going down, the commercial real estate market is collapsing, the rents, people are defaulting on their obligations for rents and for carrying through developments. So there's a real danger that there could be further cash problems for these banks. So it's not over yet, and that if that spreads into the commercial real estate sector in a big way, then we could see the Fed is going to have to plow in a lot more money. So I would add too at this point that some people will say, well, this is not a bailout. What's happening is the Fed's providing liquidity. If a bank goes under, other banks are coming in either to buy it up or to offer it money. So it's not going to affect the ordinary person in the street or at home in any way. Well, that's not really true, because what this is doing is it's reducing the ability of the banks, but they're losing a lot of capital in doing this, and it's reducing their ability to lend in order to meet the big ticket items that we require as individuals, householders, but also in businesses and so on. They're going to find it much tougher to get loans. The cost of interest rates for those loans have risen considerably, so it's going to squeeze the US economy and other economies as we move into. And that's the underlying problem here, that what we've seen after a bonanza of profit growth since the pandemic in 2020 through 2021 and into 2022, and a massive rise in inflation, we're now beginning to see a turnover of that. The profits that the big companies are making are being declined, and the small companies are going under. There's always been something like 25% of American companies that barely survive on the profits they make in order to pay the debts that service the debts they've got. We call those zombie companies, and they've been around for a long time. But now the situation is squeezing many of these companies, and it's going to make it very much more difficult as the lending conditions from banks rise and interest rates rise. So the policy of the Fed to fight inflation, as they call it, which is a nonsense, but that was their policy, is actually squeezing Main Street and the smaller sectors and regional areas around the country, and leading inevitably to a situation where it will accelerate what I think was already developing, which is a move towards a slump and a recession. The slowdown in the US economy is visible, except in employment, but that's something we could perhaps discuss, but it is visible. Only last week, the Federal Reserve projected this year's growth rate for the US economy at 0.5%. 0.4%. Only 0.4%. That's not a recession. Well, that's okay. I don't know if you'll notice the much of a difference between 0.4% and 0, but I would add that the measurement of the credit squeeze that is now being applied as a result of this banking crash means that that 0.4% is going to disappear. By the middle of this summer, I expect to see figures which suggest that the US economy is in contraction. And already that applies to Europe as well. So the tightening process is going on. We have the crisis is not over. The squeeze is on the credit sector. The economy is beginning to buckle under this pressure. So inevitably, we're going to have a situation where it will get worse in terms, mainly not in the banking sector, but into Main Street itself. And that's the real issue that faces ordinary people, because it means then unemployment will start to rise. Then it won't be possible to compensate for the big price increases we've seen over the last 18 months. That's the situation that the banking crisis presents to us, and it shows us as an example. Finance is always unstable. It has an inherent instability. That's something we as Marxists and Socialists have understood and explained for some time. But now it's coupled with the inability of the Main Street sector to grow as a result of the squeeze and the crash that's taking place in banking.
Thank you. That was helpful. David, do you want to go ahead?
Yes, thanks, Shireen, and thanks as always to Haymarket Books, who are just amazing sponsors of events like this. To you, Shireen, and to Amanda, to Sean, and to Ashley, who are making all of this happen behind the scenes. It's always much simplified following Michael, because he has laid out with such clarity the overall perspective as to what's going on. And I will really just try to fill in a few areas around the margins and maybe come back in a little more depth to the question of why central banks in North America and Europe are so obsessed with ostensible inflation at the moment, and what is driving that. But I'll start really by saying that the safe prediction, as Michael has made clear to us, is that we will see more bank failures and that we will see a global recession. The precise timing, the precise dimensions of this are not predictable, but the basic dynamics and rhythms, I think, are. Even in the mainstream, we're starting to see some growing recognition that there are, shall we say, some problems out there. My two favorite descriptions of the past week or so were one from an asset manager who referred to what we're confronting as, quote, a slow rolling crisis, unquote. But my favorite is a New York University economist who said we're looking at, quote, a zombie horror flick. And friends at Haymarket will know my particular appreciation for zombie and vampire metaphors. Now, I'll come back to zombies, which Michael already touched on shortly. But let's put this in a bit of a context initially. We are still looking at the legacies of the economic crash of 2008-9 and the way in which central banks around the world intervened to prevent what they perceived as the beginnings of a catastrophic meltdown of the global financial system. And so they intervened with a speed and a depth which they'd never used before. It really didn't matter how large the bailouts had to be. It didn't matter how massive so-called quantitative easing had to be. And it didn't matter if they effectively drove interest rates down to zero so that anyone with some kind of incorporated business could borrow and borrow virtually for free. And the result was that they did prevent a complete meltdown of the global financial system. But it also meant that we did not get the kind of restructuring that a deep slump causes. Because as Michael has written about many times, 2008-9 was driven by a global crisis of overaccumulation and declining profitability. And in that situation, the inherent mechanism of capitalism is that the least efficient units of capital get driven out by a slump so that the most efficient can restructure, grab greater market share, reorganize production, and reestablish profitability. But if you flood the system with liquidity, the way the Fed and other central banks did, you allow so-called zombie companies to stay alive. And as Michael and others have written about, something like 15 to 20% of the companies out there in Europe and the United States today were so-called zombies before the Fed and other central banks started raising interest rates. To be a zombie means that there is no inherent profitability. They're on life support, and they can stay on life support so long as money from the banking system is effectively free. But once the Fed decided that its inflation fighting, to which I'll return, was necessary, and therefore they started jacking up interest rates, those zombies now have a problem. If they are going to roll over their debts, for instance, debts that were at 0.75% now have to be renewed at 3 and 3.5 and 4%, and they're not generating the profits to sustain that. As a result, we began to see loans in these sectors really drying up. In commercial real estate, so far this year, loans are down by 50% in the United States. In other words, companies that are sitting there with half-developed shopping malls, with office towers that have only 40% capacity, 60% of the office space is sitting empty, they're not making money. Now they're coming under a credit crunch. And so this is going to be exacerbated. They started, therefore, to pull cash to meet operating expenses. And so a bank like Silicon Valley or a bank like Signature, with loads of loans out to companies in this sector that were now scrambling, these sectors, they began to watch deposits flee. Silicon Valley firms, commercial real estate firms start to draw down their deposits. So they were cash short, and as Michael said, they then had to cash in depreciated assets. And that means booking losses, which is disastrous for the viability of banking. About 70% of the nearly $6 trillion in commercial real estate loans in the US are in the hands of small to medium-sized regional banks. These banks are incredibly vulnerable going forward. And as a result, more and more depositors are going to lose faith. They are going to keep shifting funds out of this sector. So when interest rates started to go up, what we really had was a transformative moment in which zombie companies were now producing zombie banks. I really want to emphasize this point. The zombie companies that have survived since the crisis of 2008-9, that crisis of overaccumulation and declining profitability, those companies represent the fault line of the system that is now being manifest in the very banks that have been servicing them. So that's why I like this metaphor of zombie companies now producing a set of zombie banks that are in deep trouble. Okay, given this scenario, why is the Federal Reserve Bank in the United States, the European Central Bank, and others, why are they pursuing a so-called war on inflation? And here I want to suggest that the primary reason is to wage class war from above. That while it is absolutely true, as Michael and others have pointed out, that the wave of inflation was not driven by a wage explosion. It is not true that wages have driven this inflationary cycle. The central bank in the United States in particular has been expressing deep concern for over a year about an impending wage explosion. In other words, the danger that workers begin to play catch up with rising prices. When I first came into the left as a teenager in the 1960s, it was very common for unions in Canada at the time to be winning double-digit wage increases in a single year in contracts because they were dealing with 10 and 12% inflation in the consumer price index. And the Fed as a central bank has been very focused on two key things: the so-called quit rate in the United States, what some people have called the Great Resignation. The greater willingness of workers to leave behind low-paying jobs because they know there's another employer out there. And so-called tight labor markets have made this possible. So that last year, for instance, 4 million US workers just quit a job and moved on somewhere else. And they were in search of better wages and working conditions, of course. At the same time, in the 12 months that ended last September, there were 2,500 union petitions by groups of workers in the US before the National Labor Relations Board. And this was more than a 50% increase from the year before. Workers at Starbucks, Trader Joe's, Amazon, Apple, and so on have all been organizing on the job. The Fed's worry is that an inflationary environment will ultimately provoke more unionization and a wave of wage strikes. And I'd love, Michael, in our conversation afterwards, to hear your thoughts on the British and European cases in this regard. I want to give you a quote from Jerome Powell, the president of the Federal Reserve Bank in the United States last June at a press conference, when asked if wages were really the target of what he was doing. And Powell, in a certain kind of central banker doublespeak, said the following, quote, "There is a very, very tight labor market, tight to an unhealthy level. If you were moving down the number of job openings, you would have less upward pressure on wages." If you were moving down the number of job openings means if you were inducing a recession that was creating less demand for workers, this would have a dampening effect on wages. Now, Paul Volcker, who led the big shockwave against inflation in the 1970s and 80s, said famously in 1979, quote, "The American standard of living must decline," unquote. Really, that's what Jerome Powell is saying in his own way. We're going to make sure that there is no rising wave of labor insurgency in the United States, which drives up wage levels and imperils the profitability recovery that they so desperately need. So let's be clear that this is not about economic well-being. It is about inflicting pain on the working class by, quote, moving down the number of job openings, unquote, in order to suppress income growth, depress labor organizing, and protect profitability, which is all another way of saying, and I know I 100% have Michael's assent on this, that it's a reminder that we ought to be done with capitalism.
Great, that was great. Thank you so much. Michael, I want to invite you to respond to David, but also for those watching, remember to enter your questions in the comments section, and we'll take them up. And thanks to both of you for making this topic accessible for us. Go ahead, Michael.
Well, David's raised a question: what's happening in the UK in the same way as the Fed is operating, and Powell's position in the US. We have it possibly even more stupidly in the UK with the Bank of England Governor Bailey, who this is even the financial analysts reckon he's the most stupid Bank of England governor we've ever had, because he blurts it out all the wrong way. And he only said at the beginning of the inflationary spiral we took about 6 months ago, when the inflation picked up. By the way, UK inflation is not even slowing down at the moment. The last figure for the UK was 10.4%. We're still in double digits. You Americans are having it easy. And in that situation, when the acceleration of inflation took place, Bailey said, look, I'm not saying people shouldn't get increased wages, but if they ask for more money, all they're going to do is drive prices up more. And so it's self-defeating. So what we want is wage restraint. And that will bring down inflation. So it appears that the position of the Bank of England governor is the solution to inflation is to hike up interest rates as high as possible and to hold down wages as low as possible, even if that means people losing huge amounts of money each year. We estimate in the UK we can have a 6% fall in living standards during the last year. And this is the just to tell you guys over there that the restraint on real wages in the UK has lasted the longest and as heaviest for 200 years. That's how damaging the inflation rate is at the moment. And yet our central bank governor says that we need higher interest rates and we need to hold down wages, just as Powell has said something similar. And over in Frankfurt, we have the European Central Bank with Christine Lagarde telling everybody last week that there is no trade-off between hiking interest rates to control inflation and financial instability. In other words, we keep on hiking interest rates to get inflation down. It won't have any effect on financial markets and on the state of the banks. Well, I don't know how demonstrably true that is now after the last 3 weeks, because clearly it is a trade-off. And the evidence is clear that that's the direction. If they continue to hike interest rates, they will squeeze the banks' credit. The zombie companies will get in a worse position. And we're heading not only for a slump, but probably a rolling series of bank defaults over the next. Now, maybe they'll reverse that policy because it will frighten them so much. But that's they're putting a brave face on it and going for it. I'll just finish on another point. Hiking interest rates to control inflation is ridiculous. It's not working. It's never worked. The reason for the inflationary spiral we have at the moment is clearly to do with the massive increase in energy and food prices in particular, and also the fact that it's had a hit through supply chain blockages since the pandemic. It's nothing to do with excessive demand or too much wages. We need to cut interest rates, actually, to keep the economy going rather than raise them.
Yeah, I'd love to come back on Michael's point there, because there's a fascinating study. Anybody who wants to find it can just go to a site called Real Economy, where two economists, and I might quibble with elements of their model, but I think they're broadly right. They argue that for the US economy to get to 2% inflation will require a recession with job losses of 6 million. It will require a more than doubling of the current unemployment rate. The official rate will have to go up to about 7.3%. We know the reality is higher. But the point is, really what they have to do if they want to wring inflation out is to induce that kind of recession. And there is absolutely no doubt, going back to the points that Michael and I have been making about startups in Silicon Valley, commercial real estate, and so on, that you're going to see a whole lot of firms bankrupted. And it's going to mean that a lot of banks in these sectors have bad loans out there. One of the things that's really interesting about the so-called bailout of First Republic Bank, always read between the lines, because they say, oh, no, we're not bailing it out. Another bank is buying up its assets. Well, no, what banks are doing is they're coming along and picking and choosing like vultures. So the commercial real estate portfolio of First Republic Bank is not selling. No banks out there want those assets. And that's telling us right now that if the central banks keep pushing in this direction, those 6 million job losses in the United States, the doubling or more of the rate of unemployment, will have recessionary impacts. But that's why I think we're both insistent that this is a form of class war that's being waged through central banking, and it's got nothing to do with somehow, quote, stabilizing the economy.
We do have some questions coming in if you'd like to pivot to those. Let's see. What, if anything, can the U.S. or other states do about bank failures? Will the bailouts work? What about regulation, and how will this impact inflation? And what can the central bank do but raise interest rates if import prices, energy, interrupted supply lines rise? If you want to take those first.
Well, let me say about regulation. I mean, regulation is usually the answer provided by all the economists and the officials. Only this week, the international head of regulation, the Basel III head, which the Basel III is the way in which banks are supposed to be regulated, how much capital they've got, what risky loans they're making, and so on. They're supposed to keep to certain rules. Internationally, everybody's supposed to follow this. He said the trouble with regulation is that nobody keeps to it. They keep not keeping to the regulation. They break the rules, and then we have to clear the mess up afterwards. And that's the situation. Regulation, trying to regulate big banks and companies everywhere in regulation is supposedly the solution to keep capitalist operations keeping to the rules of the game. Is just a nonsense. It doesn't work. Capitalism is more interested in making profits. The banks will break the rules. Take, for example, Silicon Valley Bank. It was quite clearly going into a serious risky area by putting all its available cash into long-term bonds in order to make a higher rate of interest than it was getting in terms of where else it could have put the money or kept it just in deposits. And as a result of that, it got itself into a mess. Now, strictly speaking, it wasn't quite against the rules, apparently. But why not? A regulation was obviously insufficient that banks are allowed to expand in this way their risky assets without any regulation. And after the event, of course, everybody says, well, that should never have happened, although there were always warnings that it was. So regulation is a complete useless weapon in order to bring about stability for working people and be sure that their banks are safe. What we need are banks that are a public service. We don't need banks that speculate in investments, that can engage in all kinds of exotic ways of trying to make huge amounts of money internationally and nationally. What banks should be for is to look after our money, pay us our money out when we have to make transactions, and provide loans at reasonable rates so that we can buy our big ticket items, or small companies can get the money they need, not to be zombies, but to expand their economy. But we don't have banks like that. And if we do, they're so weak that they're the first ones to go. And as David was saying, the big banks are now picking up and the bits and pieces of the assets of these small banks that are going to war. That's a solution. It's not a solution to me. Take SVB. It's now just been taken over by First Citizen Bank, which is another bank in California. They bought it at a 25% discount on the available deposits and assets that the SVB has before. And the Federal Deposit Insurance Company is giving it a $35 billion loan to get on with, and a $70 billion credit line. And overall, the cost to the taxpayer, or at least the official government source, the FDIC, is going to be $20 billion in order to hand over basically SVB's assets to First Citizen Bank for peanuts. That's the sort of way in which we have a solution provided by the government. I'll finish on this point. So we don't need privately owned banks operating in speculative ventures like hedge funds. What we want are publicly owned banks, democratically run, and providing a service to the public. That should be the way forward. Let's end the control of the big multinational banks, and for that matter, the big control of the big multinational energy and other corporates.
Just picking up on Michael's points here, one way of thinking about this is that virtually every proposal to regulate that's coming from anyone within the political mainstream operates on the principle that where banks are concerned, profits should be private and losses should be public. I'll repeat that. The profit should be private and losses should be public. In other words, when they are losing money, the public, through public institutions, like the central bank, that is not meant to be anything other than a custodian of the public interest in the financial sphere, comes in and bails them out. We're going to have to ask ourselves, with this cycle of repeating financial crises that we're dealing with in this period, how many times should the public buy up the banks before you say, as Michael did, these should be publicly owned? You know, we can go through another wave of bank failures where trillions of dollars in public funds are pumped into the banking system. But at some point, you have to pose the question of, if the public is paying for them, why are not they public institutions? And that, of course, means to raise all of those questions that Michael was about the fundamental purpose of banks, and the fact that we are talking about raising the issue of public ownership of banks by way of saying that the dominant assets of the modern economy should be in public hands, serving public purposes, not private ones. So, you know, the wonderful thing about the regulation debate is that it allows you to open up all of these questions about the very structure of the modern capitalist economy. The other point I'll make about regulation is that regulators, even when they operate with conviction, and let's be clear, they often don't, but even when they do operate with conviction, are up against bankers who are constantly inventing new financial instruments that are not captured in an existing body of legislation or rules, and new kinds of financial vehicles. During the great run-up to the mortgage asset-driven crisis, these banks and other financial institutions were spinning off so-called special purpose vehicles, which allowed them to do inside their, quote, special purpose vehicles things they weren't allowed to do within their holding company, the bank. And bankers will keep doing this. New exotic financial instruments, new ownership structures that allow them to elude regulation. So at a certain point, we simply have to say, why continue with this game when, in fact, public ownership begins to fundamentally address the issue, but of course in a radical way that the mainstream doesn't even want to entertain?
So both of you talked about the issue of demanding public ownership of banks. One question I got is, what are some immediate demands that the left should raise about the financial sector? Is that one of them? Is that not an immediate demand, or what are some of the other ones?
Yeah, well, yeah, I think it is one of the immediate demands. You could say that, oh, that's a bit far away, nobody's going to support that position in the States or in the UK. It's interesting to note that in the UK, we had a left Labour Party for a while under Jeremy Corbyn. It had a reasonably radical programme. It was demanding the renationalisation of the energy industries, bringing about some of the key sectors of the big utility monopolies under public ownership. It was calling for government and public investment to take the economy forward. But one thing it did not have in its programme, which was to bring the banks into public ownership. It again had the policy basically of regulation, or of setting up one publicly owned bank to compete with all the other big multinational banks. So there's a certain taboo, it seems, against the idea of taking on the finance sector and bringing it under public ownership. But it seems to me that it's the fundamental kernel of how we can begin to change our economy for the interests of working people, rather than for those that the 1% that control everything in our society, both in the States and in Europe. If we don't have control of credit, if we don't have control of the financial sector so that we can direct money not into exotic instruments for banks to make profits on and then go bust, but into productive investment where companies need that money, where we can expand the economy and provide support also for a government plan. And until we have control of credit and finance, we can't really begin to transform an economy in the interests of working people. So it seems to me an immediate demand. And I don't think it sounds so terribly out of tune, given the environment we were in, even in the last 3 weeks. People can recognise that how, as David put it very well, how much longer are we going to go on with this game of saying to the banks, oh, you've done something wrong, so we've got to change the rules a bit more this time. And sorry about that, but here's some money to keep you going. And let's wait for the next 10 years before you go crashing down again.
Yes, I totally agree with that. And I think looking at it in the US context, what's clear is that the bank bailouts from 2008-9 were hugely unpopular, enormously so. Now, there was a right-wing move to capitalize on that, which was the Tea Party movement on the fringes and then increasingly in the mainstream of the Republican Party. But one should never underestimate the degree to which the Bernie Sanders presidential campaign was really driven by hostility to the idea that Washington is simply a handmaiden of the banks. And it allowed a discourse of socialism to reemerge on a much larger scale. Please, no one understand me. I think ultimately Bernie Sanders is a New Deal liberal. But the idea that the term socialism was in the air as a response to that crisis of 2008-9 was hugely important. Millions of young people were electrified and inspired by the idea, and we still see it with one public opinion poll after another. Socialism in both the United States and Canada remains enormously popular among young people 35 years and under. So to talk, as Michael is, about public ownership of the banks may sound like it's completely outside the political orbit in some sectors. But if you're thinking about building a socialist movement for the future, it's resonating with young people. It resonates with the young multiracial working class that's organizing at Starbucks and Amazon and Apple and so on in the United States today. The other point I'd make about this, and Michael and I would need another session to do any justice to this, is that in particular, if you're going to talk about a serious transition away from carbon capitalism, then the idea of a publicly owned banking system that would massively invest in public projects in solar and wind power, for instance, to accelerate decarbonization, makes a huge amount of sense, because you've now got the assets of a public banking system at your control to carry out public investment to transition towards a post-carbon economy. So all of these key political and ecological questions converge around this issue of whether we're happy to let the flows of money and finance be for purposes of private profit, and they can be fantastically profitable if you're Citibank or Goldman Sachs, or whether in fact we think they ought to be in public hands because the public keeps bailing them out, and therefore, if you will, retrofitted for public purposes.
Yeah, I'd ask the viewers, do we think we really want to carry on with Citibank, Bank America, Wells Fargo, Goldman Sachs, JP Morgan, Morgan Stanley to go on forever? We're not going to take control of these gangs of financial institutions so that we can use them in a more effective way and productively? Are they to go on doing this forever and ever?
Okay, there's several more questions along these lines. One question is, for how long do you think the state can put off a deeper and more prolonged recession or depression? they've been kicking the crisis down the road for a while, or do you see another outcome? I'll add a couple more questions to it at the same time, if that's okay. One is, what is the role of cryptocurrencies in this crisis? And another is, what impact will all this have on the tech sector? Feel free to take a combination, or do you want to go first, Michael?
Okay, well, recessions. Well, remind everybody that we've had actually in the 21st century, we've had 3 recessions. There was a very mild one in 2001, but it was severe for sectors of the economy. People forget about that one very much. Then we had what is called the Great Recession of 2008-9, and it was the biggest slump in production and investment and employment worldwide, most extensive, much more extensive than the Great Recession, which was concentrated mostly in the north of the hemisphere, but across the globe, the Great Recession of 2008-9, which we've been discussing, triggered by the global financial crash. Then we've had the pandemic slump of 2020, which was even deeper, if shorter, but deeper than the Great Recession of 2008-9. So we've already, as we go into the third decade of this century, we've had 3 slumps in most of the economies of the world. And now, as far as we can see, we're heading into another one in 2023 onwards. How deep it will be and how widespread it will be remains to be seen, but it's there. People haven't probably had the opportunity yet to read. Yesterday, the World Bank published a report in which they took the prospects for the rest of this decade. And it is the most grim reading I've seen in any international economic report. There is no prospect of any decent growth in the rest of this decade in all the major economies, including the US. We're talking about a further slowdown from the growth rate that we had from 2010 to the end of that decade, which was even slower than the previous decade. So the third decade of the 21st century is going to be the slowest, even slower. And then the World Bank says, and it could be slower if we have more recessions. Well, we've had 3 already. The chances of avoiding one by the end of this particular decade seems pretty slim to me. So the situation is really awful. Capitalism is past its use-by date. How do we get out of that? Well, capitalism gets out of that by actually liquidating all the bad bits, the failing bits of its system, the weak, the sick. It wants to clear the wood away so that there's forest has had its fire, and now the new plants can shoot up. The idea now is it'll all shoot up using AI and robots, and everything will boom forward in a roaring 2020s, like it was after the roaring 20s, like in 1920s after the First World War. Now they're hoping for a roaring 20s as we come out of this next one. The deeper the slump is, the better chance they've got of getting out of it, but it will be a painful experience for the rest of us. But I tell you, the World Bank report says, forget about the roaring 2020s. It's not going to happen. That's the situation which capitalism faces over the rest of this decade. So can capitalism get out of recessions and move on? Yes, it can, if it hits us hard enough and enough people get injured and the weakest get removed. But if it doesn't do that, which it's been trying to avoid on the whole for the last period, as David said, then we'll just crawl along in this very low level of growth, where unemployment will remain high across the world, where wages will remain low, investment will be insignificant, the climate change emergency will hit us right in the face, nothing will avoid it. All of the latest reports say from the UN that we're not going to meet the Paris target of just having 1.5% centigrade increase in global temperatures. It's going to go higher than that, maybe even 2.5. There's no prospect of solving these major problems, and capitalism is failing. It's failing really badly. I haven't dealt with the other things. I'll leave that to David.
Well, let me start with cryptocurrencies. There continues to be an enormous amount of confusion about these things. First off, let's be clear. In any meaningful sense of the term, these are speculative commodities, not money. Okay, I want to emphasize that. As a result, there can be speculative bubbles that will drive up the prices in a given cryptocurrency for a period of time, just like Dutch tulips could go through an extended speculative bubble. But if you're asking the question, can the financial system significantly shift in the direction of cryptocurrencies, the answer is no. And I'll give you just one little example to illustrate the point. Many people know that I'm living and working in Houston, Texas these days. In a relatively smaller town in Texas last year, there was a music festival sponsored by a cryptocurrency. Now, trust me, if you are money, the general equivalent that drives the economy, you don't have to go around sponsoring anything. When was the last time you saw a sports event or a music festival sponsored by the dollar? Well, of course you don't, because it's ubiquitous, because it is the general equivalent, the means of payment in all transactions. That doesn't mean that at the margins, other partial goods can play a very limited role. It is still the case if you go into prisons that cigarettes are often a currency, for instance. But if you tried to use cigarettes as a general equivalent when you did your grocery shopping or put gas in your car or whatever, you'd have some troubles. And so crypto will continue to be out there enticing people who, in the kind of economic low growth environment that Michael was describing, are hoping to get rich quick. But it will be constantly prone to great inflationary bubbles, asset bubbles that then burst. And the other thing, which I think more and more people are finally starting to get, is that there are some big players in this game. And that the average small fry who enters the crypto game tends to get massacred. It's the same as in any major speculative investment sector. The big guys tend to be able to rig markets in their direction for a period of time and then get out. And then the crash hits the small guys. That's tended to be the pattern. So crypto is going to continue to be out there, enticing people looking for get-rich-quick schemes, fast bucks, and so on. It's also going to be prone to the kind of volatility, and I mean extreme volatility, of the sort of crashes that we've seen.
David, can I ask you, did they pay in dollars for the festival? Or
exactly, Michael, precisely. Even if there was, transaction to buy a hot dog or a beer in crypto somewhere, we all know that ultimately every one of these cryptocurrencies is measured in dollars. That's what it's valuated in. And that tells us everything we really do need to know about them. So watch crypto as a sector that could have great asset inflation and then enormous bursts and bubbles of the sort that we've already been seeing. And I don't see that probably disappearing anytime soon in this volatile environment, but also don't have any expectation that there will be any major move in that direction. Final point, crypto is not the same thing as a government central bank creating a digital currency. That's very different. The Chinese central bank is moving in this direction right now, but these are state central banks that start to digitize some of their currency operation, and that's not cryptocurrency.
I was going to say, Sharon, what do you think about the tech sector? I'm not an expert on this area, but it's the key area. It's a key area for not only the US economy, but everywhere. And at the moment, we're all going mad over ChatGPT and all the other machine learning devices, AI, that are hitting the media now and being used by people. There's a lot of talk about this is going to create the conditions for a huge takeoff for the tech sector, and therefore maybe a new area for capitalism to accumulate profits and growth. I'm not so sure. I don't know what other people think, or Dave thinks.
And Michael, I often use a lot of your writings to guide me here. And by that, what I mean is, look, robotics, for instance, are real in modern manufacturing and assembly line production. Robotics are there. But this has not resolved the productivity crisis.
No.
I mean, productivity growth in this century so far in the United States has been about 0.5% a year. And 0.5% a year compared with a kind of, overall historic level of 3% a year speaks to all of those issues that the World Bank report that Michael was describing is talking about. A low growth capitalism that really is literally staggering to stay afoot. And not to simply lose its balance and topple over. And so there's no doubt that a given company in robotics may do very well. A given firm in AI may do quite well. The same is true in biotechnologies in the medical field, for instance. But that's very different than turning around the whole environment of profitability and investment. And Michael has shown in a series of writings that there is a long-term depression of profitability, and until it's resolved, the system cannot attain dynamism. But the problem, as we've been talking about, is that the sort of bloodletting that would be required, the deep, deep recession/depression that would be required to radically reconfigure the global economy is immensely destabilizing. And frankly, just like they really believe that the global financial system might come down in 2008-9, they know that too. And so for all the bluster right now about controlling inflation, I don't believe that there is any stomach within the global ruling class today to stand back and say, let a global depression rip and we'll see who's standing at the end.
Yeah.
The costs of that are incredibly high. And I don't just mean economically to enormous sections of capital, but also politically in terms of the oppositional forces and the insurgencies that it might generate.
That relates to a question I was going to ask. How will all of this impact class struggle in politics? You both talked about 2008, and we know it triggered a massive wave of protests and uprisings globally. Is there the potential for fight back in the current moment? We're seeing a little bit in France, but what chances are there of this spreading, or what effects does this have on the political economy, basically, and class struggle?
Well, we have seen an intensification of the class struggle on the level of strikes and industrial disputes. I was looking at the UK figures. We've had a huge jump this year for the first time since the 1980s, which shows you perhaps the change has taken place. It's been decades. I was looking at the UK industrial disputes figures. For decades, they've been virtually down the bottom, near the zero line. Nothing much happening. Either been made settlements without industrial disputes, or they've accepted the situation that they've got. And we've had real wages as stagnant now in the UK for 20 years. Real wages, that's after inflation. Yet, in the last year or so, because of the impact of the pandemic and because of the energy and food price multinationals massacring the pricing market, 15% increase in inflation over the last 2 years on average in the major economies. I'll put it this way, when the central bankers tell us that inflation is slowing down thanks to our efforts, it's fallen from 8 to 6, what they forget or don't want to mention is, so now it's at 6% and not 10%, but over 2 or 3 years, That's 15% increase in prices. They're not going back to where they were 2 years ago. They're up high again, and the wages are not matching it. And I think that's produced a response from certainly the better organized sections of the class, both in Europe and in the US. But also the other factor, and you probably know better, is the development of new unions or new areas of workplaces that have been totally unorganized for the first time in key sectors of the economy, like the tech sector, like the social media sector, and so on. For the first time, with just the first signs that these people can organize. I've always thought the way forward for a intensification of the class struggle would not be to expect the public sector or the older traditional unions to be the forefront. We have to look for the new sectors that have grown over the last generation. And those sectors are just beginning to start that organization. Reminds me historically of the period after the Great Recession of the 19th century. At the end of the 1880s, early 1990s is when mass unions exploded again in areas that hadn't had existed before. I think there are inklings of that's the direction that we're going to go in terms of working class struggle. Just to put it on the other side, though, the increasing forces of extremism on the right that are looking, maybe the ruling groups, the mainstream groups, the ruling groups don't want an intense class struggle. They're prepared to just trundle along, but their extremist forces are increasing in their intensity to take it on with the class. And that's the danger that we could see in the future.
Yeah, I'll start really where Michael was just concluding, and then I want to shift to a different region. But I think that's absolutely right, that when you look at what were the high growth sectors within US capitalism in this century, for instance, that's where the unionizing is happening right now. This is where young people are starting to organize. You know, about 15 or 20 years ago, Robin Kelly essentially said in a really interesting essay that the left had to pay greater attention to the new multiracial urban working class in the United States. And he was really trying to say to people, don't imagine that the next wave of radical labor and working class action and organizing is going to look just like the last one of the 1930s and 40s. And what we're now seeing is that young, urban, multiracial working class in the United States beginning to move towards a greater sense both of the significance of union organizing and workplace action. And that's why I mentioned, for example, the petitions to the National Labor Relations Board that had doubled last year, 2,500 of them. And we need to emphasize these are the same young people who have been radicalized around Me Too and the Black Lives Matter mobilizations. For them, gender equality and racial justice are intrinsic to organizing in the workplace. And so they're not stuck in the first instance in a narrow business unionist model. They're expecting workplace organizing to address gender and racial justice issues as well as wages at work, working conditions, and so on, job security. Ruth Wilson Gilmore, when the first wave of the Black Lives Matter movement happened in the US, she said about the uprising in Ferguson, this was an uprising against austerity. And all kinds of people went, what? What's she talking about? This was against police violence. But what she was saying to us is, look, these are young working class people who are furious with the police. But this is not new what the police are doing in Baltimore or Ferguson or later in Minneapolis or Atlanta or Memphis. This is not new, but somehow it's producing an uprising today in 2013, 14, 15, and so on, as it did again with the George Floyd uprising in 2020. She was drawing attention to the fact that this is a new layer, a new generation of young working class people coming into social struggle. And I think, and this is the point I'll conclude these ideas with, I think we have to pay great attention to Latin America right now. Because the crisis that we've been describing of rising interest rates is also translating into the beginnings of another global debt crisis. And it's hitting countries where, in fact, there has already been a wave of working class and popular insurgency. If you think, for example, about the enormous uprising of young people against transit hikes in Chile, which then produced 3 general strikes as unions came out in solidarity with the young people. It started over transit hikes, but then it spread. And not coincidentally, there was a feminist component to that upsurge, which has now won reproductive rights in Chile at a level that's never been accomplished before. We see something similar in Colombia, something similar in Peru, and so on. I think we have to really pay attention to a rising wave of popular struggle in Latin America in the next year or two. And I think that you can't, for instance, put Bolsonaro's defeat outside that context recently. These kinds of developments are going to be the key to blocking the right, which, as Michael says, we know is very potent and dangerous right now, these new far-right forces. But they struggle for traction when broad popular upheavals take place, where, in fact, social movements and unions are beginning to address the key questions of the moment. And I suspect that we're going to see some really significant kinds of insurgencies in parts of Latin America. But I'm also not without hope where it comes to rebuilding working class organizations and a more viable left in places like the United States either.
Yeah, thank you. It's important to mention the how it fuels the right and the far right. Especially, we know, the 2008 crisis brought about extreme polarization. Just a couple more questions. How will this crisis impact geopolitics? Will states turn to more protectionist measures? And how will it affect globalization? And what will this do to rivalries between states or imperialism, maybe?
It's a very good question. Clearly, the 21st century, one of the features of the 21st century is the end of globalization in a way. That we've seen the period of the last 2 decades of the 20th century saw this huge expansion of global trade, the breaking down of tariff barriers and other barriers, but also the dramatic expansion of capital exports and the spread by multinational companies from the global north into the global south to exploit the labor of the global south, and also to develop their financial and other areas of control over the global south countries. But since in the 21st century, that's beginning to reverse. What we've now seen is a decline in global trade growth, whereas it was growing faster than global growth, that's GDP growth, it's now more or less the other way around, or at least no better. Global trade growth has slowed down even slower than global GDP growth, which means that the escape valve for capitalism of expanding exports abroad, of expanding finance, of trying to use the labor of the global south to get extra profits is becoming more difficult to achieve. And also that has meant that the hegemonic position of the US economy and the US dollar has also relatively begun to decline. I don't want to exaggerate the fact that the US dollar is still the dominant currency in the world, and the US economy is still the biggest economy and the most important capitalist economy in the world, particularly militarily, of course. But it has lost its overall dominance, and increasingly there's a share of trade, growth and finance which has moved elsewhere, not just into Europe and Japan and the other G7 economies, but now we begin to see it with the rising, particularly, of course, of China, but also in the case of India and other countries that are no longer completely dominated or in fact in direct opposition to US imperialism and their allies. And now we enter a political period, particularly from the Russia-Ukraine war, where we have this division of political influence between different geopolitical groups that is developing. It's no longer going to be a unipolar world or Pax Americana. We're now entering a multipolar world where US and its allies, to some extent in Europe, and then we have these new forces of Russia and China, perhaps in alliance, maybe not, with other developments which are no longer straightforwardly under the grip. Whenever we've had a multipolar world under capitalism, it led to serious conflict, geopolitical conflict, because it's much easier if one dominant power can set the peace, like the world's policeman. If we're now going to have a struggle between different blocs over the control of trade, finance and investment, that could also mean an intensification of the risks of military conflict. And of course, we know the big one will be if we have such a conflict between China and the US sometime towards the end of this decade or even earlier.
I totally agree with what Michael has said there. And I think people have to understand, because very often our thinking about the world takes some time to catch up to new realities, new phenomena, new developments. It was very easy for us to understand a certain historical period as one of the globalization of capital. And there were all kinds of measures by which you could make the case. Now, they were overstated in a variety of ways and so on, but they captured something real. I think Michael is right to say that period is over. We are now seeing the fragmentation of the global economy and global power in ways in which there are now contending blocs to a greater degree than we have seen since the Cold War era. And so this is a kind of post-Cold War blockification, if you will, of the world system. And I think some people, in the mainstream in the US thought that protectionism was simply a Trump phenomenon. They were wrong. The Biden administration has doubled down on protectionism towards China, particularly in a key strategic area like microchips. And it is doing everything it can to impede the global flow of technology, intellectual property, scientific knowledge, and indeed even capital flows in the sector. That doubling down, which takes the on protectionism, which can take the ludicrous dimensions, say, of an attack on TikTok. Now, I'm not the TikTok demographic, so it's not huge for me, but there are a lot of people for whom that is a real issue. But the point is, it's part of the performance of global rivalry, whereas the real issues lie around things like microchips, new technologies, new weapon systems, new surveillance systems, and so on. I could say the same thing about the so-called spy balloon that Biden had shot down. I mean, come on, really? We're that naive that we don't understand that there is mutual spying 24/7 happening between these different centers of power in the world? Of course there are, but it's highly performative and it's designed to whip up the fear of the other center of power in the world. And so it's a much more dangerous time as well in global politics for us right now. And for all the reasons that Michael and I were talking about, these tendencies that are dangerous are likely to get worse, not better, in the context of a global slump. But at the same time, and I think it's something that each of us has been at pains to highlight, this kind of crisis poses a series of key political questions, like how long do you want to continue with a banking system where profits are private and losses are public, for instance? Those kinds of questions, as they did in the aftermath of the 2008-9 crisis, and we saw them manifest with both the Corbyn phenomenon in Britain and the Sanders phenomenon in the United States, this will open up new political space. And then the key question becomes all of that grassroots on the ground political organizing that we hope so many of the people who are listening us today are a part of. So it's not to deny that this is a very volatile, dangerous time for all of us, but it is also to say that there are multiple possibilities that get opened up in a moment like this, and some of them involve openings to the left, as we saw during the last crisis. And so the question is always open for us historically. Class struggle's not over, popular insurgencies are not over, working class and socialist movements are anything but finished at this moment.
Thank you. Michael, do you want to add any last comments? And then
I think David has summed it up. I was struggling to think of anything to add. Just to remind everybody, though, that there are things that, like the climate emergency and global warming, is not an issue that's far away now. It's part of this, all the challenges facing us and capitalism, for that matter, in this decade. These questions are going to have to be resolved one way or the other before this decade is out, in my view. So time is running out, if you want to put it that way, for considering this, and it's time we move on to, with a better understanding, to take action about it.
Great. Thank you to both of you, Michael and David. I definitely learned a lot, and I'm sure a lot of others did. And thanks to everyone for coming today, to Haymarket and Sean and Amanda and Ashley. Remember to subscribe to Spectre Journal for more Marxist politics, and see you at the next event.